Good day, ladies and gentlemen. Welcome to IPE Real Assets. I'm Brendan Mayton for IPE. Today we are looking at infrastructure debt. I'm delighted to welcome back one of our seasoned presenters, Abhishek Gupta from EDHEC Infra. Abhishek, welcome back.
Thank you, Brendan. It's always a pleasure to be back with IPE. And as you know, we have been a bit busy, so I'm back here in less than a month, I think.
Less than a month, but it's a different topic, folks. You're going to learn more about
an entirely different topic. Yeah.
infra debt today. Last time we were looking at the different sectors, different types of infra investor, what they're doing and why. Today we're concentrating much more on infra debt. If you read the blurb to this webcast, you'll know that it says infrastructure debt is new to IPE viewers. Abhishek, let me just start with a challenge. I find that surprising. I think that not only is infra debt well known to IPE viewers, so some of them even have been a bit disappointed by the returns from infra debt. Certainly some in the UK.
Yeah.
What's your comment there?
No, I think the point is more from the allocation standpoint, right? When you start to think about the portfolio strategic allocation, what we find is that there is scope to do a lot more with infrastructure debt, as with equity as well. And we will demonstrate it in these slides as a brief snapshot of a paper that we had published some time back. The point is that it could take up to 10% of the portfolio allocation. And that's what we wanted to focus on, that investors are still getting on board with this as an institutional asset class in the portfolio.
Yeah. You mentioned 10%. I mean, that's a big chunky figure, and that's something for the audience to think about before they hear you present and show the results from that modelling survey. That's for a mature asset owner, by the way, folks. Is based on a roughly sort of 80-20 split between debt and equity, which I like better than the familiar kind of 60-40, 40-60 split. The point is that kind of modelling isn't really well done if you are using old-fashioned, we could call real infra information, is it, Abhishek? That there's not much of a secondary market for infra debt, rarely traded. A lot of it is bought to be held to maturity. What you've done and what you're going to show as part of this presentation is that EdTech Infra has been able to model, using obvious factors like size of the debt, and give people more of a real-time sense of what the debt's worth and therefore how to fit it into a strategic asset allocation.
Exactly. I mean, that's the point, that having all this data and the extent of the data that we hold, we can build models on top, which can be used in applications such as strategic asset allocation and so on, and we can get some conclusive answers about what the level of allocation should be.
Okay. Should warn the audience that we've got a couple of questions for them. We like to gauge their views. We're going to ask them about inflation linkage in infra debt, which I think is a very moot point given where we are today. Abhishek, let me hand over to you to present. I'll just remind the audience it is interactive, so not only are we going to be doing those polls halfway through, but any questions, challenges, comments you have on what you hear from Abhishek Gupta from EdHEC Infra, then do fire in an email with your name and the organisation you represent. That's very important to us at IP Real Assets. I'll put your comments and questions to Abhishek in about 35 minutes time. Abhishek, over to you.
Thank you, Brendan. And that was a perfect segue into this presentation. So this topic is new, like Brendan mentioned, and I'm going to talk about benchmarking private infrastructure debt as a whole. So we are going to look at several measures, looking at the indices that we have built, looking at the credit risk metrics and so on, and talk about also the inflation linkage in infrastructure debt. The idea is to use all these measures and show you that with the extent of data that we hold in Inframetrics platform, it is possible to benchmark infrastructure debt asset class, even though it's an illiquid asset class, but it is still possible to get these kind of secondary market sort valuations and use them for your benchmarking purposes or your portfolio comparisons. Before I get on with it, here's a brief about myself. I've been at edX Infra for close to 4 years now, and I head the product development team. So I'm in charge of developing all the products that you see in Inframetrics. Most of the audience would already be familiar with edX Infra, I assume, but here's a brief recap. So we started 10 years ago as a research on infrastructure, and we were still part of the edX Business School at the time. Then we were integrated into edX Risk Institute. So we were still doing research on infrastructure. We have 10 years of experience in total in that space. And in 2016, we were spun off as a separate institute. That's the edX Infra Institute. And since then, we have created some groundbreaking research on infrastructure on many, many topics over time. In 2020, we set up a new venture called Scientific Infra, which is a commercial provider of index data and analytics in infrastructure equity, as well as debt. And this is the platform that we offer commercially to our users. It's called Inframetrics, and it has components that can serve needs for all infrastructure players in the market. We have a valuation metrics product, which can help investment teams or valuation teams to understand the valuations of different segments of the market. We have a market indices product, obviously, which can allow you to benchmark your portfolio against these market benchmarks. We have a fund strategies product, which can let you compare the historical performance of different funds across strategies and vintages and so on. We have a dedicated risk metrics product, which let you drill down deeper into these sophisticated risk metrics, ranging from expected returns, equity risk premia, to the credit risk on the debt side. And then we have two upcoming products on asset ratings and peer groups. Peer groups is the one that I presented with IPE last month. So these two products are going to be super interesting, and please do look out for them as they are launched later this year. So a brief note on our clientele. You will find some familiar names up on the screen. So as of April this year, we have clients who represent 29 trillion in AUM in total, and that includes 350 billion in just infrastructure AUM. So a lot of investments are being done in infrastructure via the users of our platform. And you will find that it includes not just asset managers, but asset owners, banks, consultants. So it ranges across these different categories of clients. Right. So regarding the agenda for today, first I'm going to talk about a brief note on infrastructure debt. What type of infrastructure debt exists in the market, and how we cover in Inframetrics, what the allocations look like by different sectors, business model, and so on. The second point we'll talk about is what the main challenge in getting the valuations. That's about estimating the credit spreads. So we'll go into this model details a bit. Then we'll look at some of the popular infrastructure debt indices that are available in Inframetrics, and we'll drill into these risk and return analysis for these indices. We'll look at interest rate risk, inflation aspects. We'll look at more credit risk metrics and so on. And finally, I'm going to do a small section on the role infrastructure debt can play in a multi-asset class portfolio. It's taken from a research piece that we had done some time back, like I mentioned, and I'm going to show you why infrastructure debt is important in an asset allocation context. Right. So understanding infrastructure debt, it's of mainly two types. We have infrastructure corporate debt on one side and project finance debt. Project finance debt is exclusive to infrastructure space, and we'll go into characteristics of each of them. Infrastructure corporate debt is akin to any other corporate governance structure that you find in other industries. These are companies which can operate multiple projects at the same time. So they are not restricted to any one activity. They can also invest internationally in other geographies and so on. The management of these companies have more freedom to make investment decisions, and they can change the course both strategically as well as financially as they go along. So they have that freedom to make these changes. Companies are also free to change their financial structure, and they can use both kind of financing, public or private, so they can issue listed bonds and so on. Creditors play a much more limited monitoring role in infrastructure corporates, and they also don't play a leading role in the financial structuring of the firm. And all these things are sort of opposite on the project finance side. They are highly suitable to deliver large capital intensive projects that require long repayment periods. So the tenure runs up to 20, 30 years for these projects when the project finance loan gets issued. So they are really long-term projects. Uh, they are created solely to deliver a specific capital investment. That is, they are tied to that activity that the project is supposed to deliver, and the financing can be used only for that purpose. So the management has very little scope to divert any of this cash flow that is generated from the project. They have to use it for that operations of that activity. Long-term behavior of these firms is highly predictable, so the cash flow profile, the future expectations, and so on can be easily understood, and as well as how they will be used to repay the creditors. It's all very predictable up at the start. And because of all these arrangements, much longer debt instruments can be issued, and also for your liability hedging purposes and so on, you can find these corresponding durations at a relatively low cost of capitals. That's the attractiveness of project finance and why it's popular in this asset class. In terms of the data coverage and inframetrics, we have 2,500 plus senior debt instruments in our platform. They look at 20 plus years of history, so a very wide range of data set. Of course, it includes 1,100 plus project finance loans. So again, between corporates and project finance, it's a fair split of data. There are 700 plus borrowers that have issued this infrastructure debt, and they are included in our data set across 25 principal markets. So overall, it's a very rich data set that we use, and combined using this data set, we create 12 market benchmarks in infrastructure debt. One is InfraDebt 300, which I'll introduce later on in a bit more detail. We have InfraDebt 100 series, which looks at some of the prominent investing markets in this asset class, and then some other thematic indices around green infra, long-term debt, and so on. How does this debt universe is represented by these TICS pillars? So TICS is a classification standard that was built in-house, but is now adopted by the market very sincerely, and is reviewed every year. So these TICS pillars include things like business risks, sector allocations, and so on. And we see infra debt is represented quite fairly across these TICS pillars. By business risk, the most coverage is by regulated segment. It covers more than 40% of the infra debt universe, then contracted, and then merchant assets. And that's partly because these regulated companies are also of the corporate nature, so they can issue a lot more debt instruments as compared to project finance companies. And that is also represented here, that by corporate governance, project companies and corporate companies, corporate debt have fair split, almost 50% in both. But in terms of the number of assets, we have a lot more project financed assets in our universe. But the debt issued gets a bit biased because of their larger number in each corporate. By geography, we find that European debt is a lot more in our universe. America's debt is a bit less, coming at the second, and then Oceania, that includes Australia, New Zealand debt, and then Asian. And that's partly...
Sorry to interrupt. Yeah, I meant to ask, actually, this was one thing that struck me when I first saw this presentation. Can you just clarify for the IPE viewers why the European weight is larger than the US? I would have thought that there had been more infra debt issued in the US. Just explain.
Yeah, I mean, it's partly because of the market has been such. Privatization of infrastructure happened in Europe way before it happened in the US, and that's why the popularity of projects like PPPs and PFIs in the UK, it became a lot more accepted phenomena in Europe early on. So it's sort of the nature of the market, and also because in inframetrics we cover more European assets. Again, because of their origination and history, we cover more European assets at this point. So that's why the representation is more in European debt. But over time, as the policies change in the US and we collect more data, obviously the Americas allocation will also increase, and we'll see a lot more American debt in this split.
Thank you.
Sure. Uh, Finally, by the TICS industrial superclass, so that's a sectoral representation of infrastructure debt, we find that the utility companies and transport companies have the largest share of debt issued. And going back to that point, that these sectors tend to have more corporate nature companies within them, like airports or some large electricity distribution companies and so on. So they tend to issue a lot more debt instruments. So by number, the bias tilts towards these sectors. On third level, there is renewable power that has the most number of debt issued from a project finance nature, and then the other sectors represent the rest of the split. Now, with that understanding, we can move on to the valuation question. Now, we have all this data that I showed you, but the key challenge remains: how do we estimate credit spreads on an ongoing basis? Because it's not a secret that infrastructure debt market is there is no secondary activity in this market. So most debt that is invested in, it's hold until maturity. So it's only the primary credit spreads that we can see in the market, but these spreads are biased. They represent only the deal flow at that point. And also the nature of infrastructure is such that it has evolved a lot over time. Where toll roads was more popular, or power plants were more popular 10, 20 years ago, now it's renewable energy. So if you start to use these primary spreads directly, you won't be able to obtain pricing for these projects which are not popular today. That's why we have to come up with something creative. uh, and the problem is essentially the same as on the equity side, that we lack good comparators that we can look up and directly reference to what the pricing should be of particular type of assets and so on. But the approach that we take is use these primary market spreads at the time of issuance and the signals that they can generate to calibrate the valuations of secondary market spreads. I explain that process a bit here in this flowchart. So if you start on the left side, we take these biased observable market spreads. So these are the primary market spreads, and they are biased in the sense, like I mentioned, that they can be biased towards particular sectors or towards a time frame and so on. So we take these spreads and we split them into multiple factor approach. So these factors, I'll come back to it in a bit, but they are standard factors that you can expect to move the credit spreads in this market. We split these spreads into those factors, obtaining a price for each of that factor. That means instead of directly comparing spreads between different debt instruments, we'll compare these factor loadings and use them to price the credit spreads. So all the universe of these debt instruments that we have in inframetrics, they are also exposed to the same factors. So if we talk about maturity or credit risk, we also have the loadings for all these debt instruments. Once we have obtained the factor prices, we can apply the loadings on everything else in our universe and obtain a price on an ongoing basis. And this process is now being done on a monthly basis, so we can obtain a monthly valuation for the entire universe of debt instruments that we hold in this platform. So here are a bit more details on the spread model. On the left side, we talk about which factors are actually used. So first is the outstanding face value. That's the representation of the size of the debt that is being issued. And we find that in this market, at least, that the larger the debt instruments, we have lower credit spreads on them. So that means, in other words, the lenders are easily issuing debt to these larger debt instruments at a lower price. That means their credit risk worthiness is assessed based on that level. Maturity, that's a term factor. So obviously, the term of the debt instrument that is issued plays a role. and it's different between corporates and project finance, and to how much spread they can drive. Probability of default, that's a credit risk factor. So obviously the credit risk worthiness of the borrower will determine how much spread is charged to borrow that debt. And then the market rates, so the benchmark rates also play a role in understanding what the spread should be. Besides these, we have some control variables because there are some effects, such as the merchant sector, which is riskier than contracted and so on, which can't be captured directly in these factors. So we capture them through these control variables. On the right side, we have a distribution plot, and that's a robustness check of the model. We show you the distribution of the residuals, so the predicted versus the observed values, and you find that it's nicely spread out around 0% error. And we look at the median error between project finance and corporate debt in the table below, and it's under 5% for both. So that's a very good representation of how accurate the model works and the robustness of the spreads that we estimate using this model. Right. Now, once we have done these valuations, we can use them in the infrastructure debt indices. So the first one I wanted to show you is Infra Debt 300 Index. It's the most representative view of global infrastructure debt market, as it represents the most recent debt instruments of the borrowers in the Infra 300 Equity Index. So that's an index that our audience may be more familiar with. It's on the equity side and it represents the overall market. We take the latest instruments issued by those borrowers and use them in this index. Historical performance has been quite strong. As you can see in this index value plot, there are very few drawdowns over time. And this performance summary also shows you the historical performance. On the 1 year basis, it has been a negative 2.97% return. That's largely due to the increase in interest rates and so on that's driving across all fixed income market. But on a 10-year basis, the Sharpe ratio remains quite strong. It's 1.04. And by comparison, I have a S&P 500 investment grade corporate bond index. And you can see that in terms of the returns, it has outperformed this corporate bond index. So overall, it's a very strong performance in the long-term period. Here's a table across different markets. So these are the different indices that we publish in infrastructure debt asset class. And I wanted to focus on a few specific things. So while the 1 year total return is negative across all the benchmarks that you see on the screen, the long-term debt has suffered the most in the last 1 year. And that's largely due to the duration. It is 10.10 for long-term debt, obviously, because by nature, these are long-term debt instruments, so their duration is also longer. And with the rise in interest rates, that risk has been realized, and you see that valuations have dropped the most. On a 10-year basis, though, however, all the indices have done really well. The total return is quite attractive, and long-term debt has outperformed because we were in the low interest rate environment for quite long, and they benefited these long-term debt instruments over time. So on a 10-year basis, they've outperformed, but overall, very strong performance. Similarly, if we come down to credit spread row here, we find that the UK debt has the lowest credit spread at 145 basis points, and this partly due to the universe that is covered in the UK in infrastructure debt. We have more social infrastructure projects, for example, which are contracted nature and so on. We have more utilities, we have more airports. So these corporate nature assets, they tend to issue debt at a lower spread and so on. So overall, it has the lowest spread. Project finance, it has the highest spread overall, 169 basis points. And that reflects that the project finance overall has higher spread as compared to the Infra 100 Global Index. That is including of both corporate and project nature as debt instruments. And that has 154 basis points. So project finance is generally priced at a higher spread level. In terms of yield to maturity, we find that Infra Green Index has the higher yield to maturity, 4.17%. That's the highest across these benchmarks, even though the spread levels are lower, 150 basis points. So that means that the interest rates in the countries where these green assets exist, some of them are like Brazil, for example, they are in the higher side, and that's why the yields are a bit higher than the rest of the markets that we see here. All right, I'll stop at this point and raise a couple of questions to our audience. Brendan, do you want to launch the poll, please?
Yeah, I will. Now, it's quite simple, folks. The question in front of you: will infra debt continue to outperform listed corporate bonds? It's a yes or no question. Yes, the higher credit spreads in infra debt should lead to higher returns, or no, investor demand will cause compression in returns. So, Abhishek, 2 points here. One is a pedantic point. The data you showed earlier, that's of course modeled gross of fees, right? So a pedantic point.
Yeah.
Let's forget the different characteristics. Is that I wouldn't be paying as much in fees, would I, to
No, of
get
course.
to a standard IG? You know, that's fairly cheap, fairly easy. So that's a small point. But the second, perhaps more meaningful point, is that the way you've shaped these questions, it's all about supply and demand for infra debt rather than the fundamentals. In other words, there's an assumption underneath all of this that infra debt is fundamentally going to give you better performance.
Yeah, I think so. On your first question, right? It is definitely gross of fees. The are indices that I showed you, and investment grade one is obviously you can just buy in the market, but the difference is obviously a larger, in terms of magnitude. Even with the fee assumption on top, it won't be able to cover the return differential between the two indices, especially on a risk-adjusted basis. If you see, the Sharpe ratio is quite different, whereas for infrared 300, I showed you, it's a bit higher than 1. For the S&P investment grade index, it's close to 0.5, 0.6. So on a risk-adjusted basis, it makes a bigger difference in terms of outperformance. Now, on your second point, I think the logic says that the higher spreads will lead to higher returns. But we know that with the institutional interest increasing in this asset class, and in the past, the debt used to mainly come from the banks, but now the institutional lenders are also participating increasingly. And organizations like EDEC Infra, we are also building a case that it can play a more important role in the allocation. So overall, we can see that the demand can create an impact to the returns. We saw that on the infrastructure equity side. Renewable energy, for example, the valuations have increased quite a lot, and that's largely driven by the demand of those assets. So investor demand is important to consider as well.
Yeah. And I mean, investing in energy is almost becoming a patriotic act in the last couple of months. Not just renewables. One thing we didn't say, and I feel a bit embarrassed because as the moderator, it's probably my job. We didn't classify here that listed corporate bonds, you really mean IG, right?
Yes, yeah, of course.
Yeah.
The comparison that I showed you up there, I should have been clear.
Yeah. The audience has voted anyway, and it's 4-1 really, that they believe infra will continue to.
Yeah, that's interesting. I mean, so it's a more of a forward-looking question. It's like gazing into a crystal ball, but it's interesting that it's come out this way. 80% people still believe that it will continue to outperform.
Yeah, hence my thing. Structurally, you're saying that it should. Yeah, that's good. And we're doing this as a nice interval within the presentation. Should we go to question 2 for the audience?
Yes, please.
Yeah. I promise, folks, this is your last one. After this is your last test, as it were. Okay. To what extent does inflation-linked infrastructure debt act as a hedge against rising interest rates? Great question. It reminds me of the kind of question that your boss, Frederic Blanc-Roud, posed. He did a great webcast with us. I'd urge the audience to review that one too, from about 18 months ago. Lots of questions, a myth busting regarding infra from Fred. Definitely worth watching again. Okay, your choices, folks. Infradebt gives a full hedge. Inflation linkage offsets the impact completely. A partial hedge, inflation linkage cannot hedge against the rise in real interest rates. Or C, Infradebt provides no hedge against rising interest rates at all. Okay.
Yeah, so this is also an interesting question, right? Right there, because what I wanted to focus on is the difference between inflation risk and interest rate risk.
Mm.
And we have some content in this webinar that I want to cover after this poll. But I wanted to get the view from the audience. How do they perceive these risks? And when they think about hedging, what kind of investments do they look at when they think on those lines?
Yeah, yeah. You've tricked them, really. I mean, it is a very Frederick Blanc-Bruder type of question, really. Because you see two words beginning with IN. It's conflation, really, of interest and inflation. But the audience haven't been tricked, Abhishek.
Yeah,
Yes,
yeah, I'm liking these responses.
IP real assets. We smart guys, smart women, because, well, I mean, it's the answer's B. But why don't you'll show evidence for this in a minute.
Yeah, so just to cover the responses, we have 70% saying that it's a partial hedge, 12% full hedge, and 16% no hedge at all. So I would have gone with partial hedge as well. And I wanted to show through an illustration on the UK market. So
Yeah.
here is a UK inflation debt index that we have created in EDEC Infra. And this index basically focuses on RPI linked debt instruments alone that are issued in sterling. And they have a long term maturity at origination. So we're looking at 15 years plus maturity at the time of origination. As of March, it includes more than 150 instruments and has a market cap of 73 billion. So the representation is quite good, and it covers pretty much the entire UK market that is focused on these RPI-linked debt instruments. As a comparator here, I have taken S&P UK Inflation-Linked Gilt Index. So that focuses more on the government-issued inflation-linked bonds. And I show you a 10-year history in this plot. So overall, the two indices track each other quite well. Obviously, the inflation-linked gilt index has a bit more volatility. We can see that the drawdowns and jumps are sharper in the past. And to see that, we come to this performance summary table. We look at the duration. So while our EDEC Infra Index has a 7.7 duration, the S&P Index has a 20 plus duration. And that's what causes this higher volatility in the index, because every time there's change in interest rates or spreads, the movement of the index is a lot more. And we see that in terms of the volatility figures, the 5-year volatility or 10-year volatility comparisons. For EDEC Infra Index, it's about 5%, 5 to 6%, whereas it's more than 9% volatility for the S&P Index. In this quarter, the inflation-linked index has performed not so well. It has minus 5.87% return, and that's in line with the S&P index as well. And this is the point that I want to focus on a bit more. Why it's happening that even with this inflation linkage, that this index has shown negative return over this quarter. So to understand that, we have to see the interest rate risk in these instruments. To what extent do they play a role? So here I have two charts. On the left side, I'm showing you a CPI curve in the UK. It's an implied inflation curve as of at the start of the quarter. So that's a December, and at the end of the quarter, that's March. On the right side, the same thing, but a term structure for interest rates. So at the start of the quarter, what the interest rate term structure looked like, and at the end, what it looked like. So while inflation is more than interest rates overall, and we know that it's a recurring theme, it's an ongoing topic right now. The key thing is the change over the quarter. That's what drives how much the protection against interest rates you can get via these instruments. So while interest rates increased by 100 to 150 basis points over the quarter, the change in inflation is much smaller in comparison. So the real interest rates increased a lot more, and that risk was basically realized over the quarter, and that's why you saw this negative performance, -6% return almost over the quarter. So it's important to think about these risks as two separate elements and understand the valuations from that perspective. While we're on the subject of the risk, I wanted to jump guns here and cover the credit risk part of it as well in infrastructure debt. So, infrastructure overall is a bit unique in terms of its life cycle, in terms of its construction phase, and so on. And we see that in the probability of default chart on the left side. The up till year four, the probability of default increases gradually. It hits around 3% mark and it starts to come down as the asset matures and it enters the brownfield stage. So that's the typical profile of an infrastructure debt credit risk, and we confirm that with the empirical evidence from S&P. So they have split infrastructure into three rating buckets: triple B, double B, and B. But all of them have sort of similar hump-shaped credit risk profile, and you can assume that if all of that were aggregated together, it will follow similar levels as we show you in the EDIC infra data as well. So this data can obviously be decomposed further. We can go in the informatics platform and look at the similar credit risk profile by different infrastructure segments and understand the impacts to that level. Now, credit risk obviously doesn't remain the same. I showed you a life cycle impact, so that's a general view. But if you start to look at it by time, there are obviously these credit risk events that play a role. And one such event was COVID-19. So this chart focuses on that, how credit risk had increased sharply during this COVID-19 crisis. We have projects, corporates, and transports segments of the market on this chart, and all of them saw a huge jump in 1 year ahead probability of default. They were at some point roughly around 1% or a bit less in terms of PD, but in the last 2020 year, they had increased up to 3%. So that's the key thing, that the credit risk obviously can change, and we can track it in informatics using this valuation model that we have. It also differs between projects and corporates, obviously, because there are different types of instruments and the dynamics is quite different. So the first point that I wanted to make on this slide is overall the expected loss or the credit risk has reduced from the highs that we saw during COVID-19. So 1 year ago, the expected loss was 5.14%, and at this point, it's 4.38%. So it has come down from those highs, and that's partly due to the riskiness getting lower in these companies. Average recovery rates in infrastructure debt stand at more than 80%. So across all types of instruments, project finance or infrastructure corporates, we see that the recovery rates are quite high. Corporates have higher recovery rates than project finance. They stand at roughly 85% as compared to 82% in project finance. And finally, corporates also have lower default rates. We see that the expected loss for corporates is 3.35% as compared to the project finance one. So all these factors, they play a role in the valuation process as well. And we confirm this through the empirical evidence that we see from S&P Global. The average recovery rate for infrastructure is 80% in their data, and the default rate for corporates is 0.38% versus 0.73% for project finance. So all the analysis that we showed you above, it gets confirmed, and the data is much more granular. It's updated more frequently. Right, so this brings me to the last section of the presentation. What role can infrastructure debt play in a multi-asset class portfolio? And that's taken from a paper that we had published some time back, where we had considered several scenarios, different optimization targets, and so on. So I'm taking just a snapshot from that paper here, and you can refer to it later on our website. This table shows you the asset classes that we had considered. So it looks at some private asset classes and the usual suspects, the public market asset classes as well. The data for infrastructure comes from our own informatics platform. And for other asset classes, it's an aggregate of the participants in the market. So it includes asset managers, owners, consultants, and so on. We have taken these assumptions from them and created an average expectation for other asset classes.
Abhishek, sorry,
Yeah,
it's Brendan. Just to interrupt, just for the audience, if they're wondering, hang on, that says year end 2019. That's because the paper was published in 2020, isn't it? So just to be
correct.
clear, it's not like we missed 2 years for any reason because they were volatile because of COVID, nothing like that. It's simply that was the last full year prior to doing the paper. Yeah. Yeah.
Exactly. Yeah, definitely. Thank you for that clarification on my behalf. All right. So, if you look at the private infrastructure debt asset class, we see that the expected returns and risk levels are quite attractive. Overall, it's a Sharpe ratio of 0.81. That's a very attractive profile, and obviously, anything that has a high Sharpe ratio is important in a portfolio context. Second thing that is important is to understand the diversification benefit. So it's a correlation table between these asset classes. And again, part of these expectations come from the market participants, and part comes using our own data on infrastructure. So for infrastructure debt, we find that especially against corporate bonds and government bonds, the correlations are quite low. Government bonds, there's a correlation of zero point 0.4, and with corporate bonds, it's minus zero point 0.1. So it can act as a diversification benefit to the overall portfolio once included. So combined Sharpe ratio, high Sharpe ratio, and diversification benefit, it should have an important role in a multi-asset class portfolio. And that's what we confirm by running an optimization exercise. So just to clarify, on the left side, I'm showing you an allocation between these different asset classes that we had considered. And on the x-axis, the target of the optimization being different. So we are varying the target with each step, and we are running an optimization exercise to understand what kind of allocation we will get. I've highlighted two scenarios here. One is a 20/80 profile. So an investor who looks at 20% equity and 80% debt. These are more mature pension funds, like Brendan was mentioning earlier, and they focus on preserving capital and rather than targeting higher returns. That's usually their focus. And we look at their allocation in a bit more detail in the table on the right, and we find that infrastructure debt in this setting can get an allocation up to 10%, 11%. And that was a very interesting outcome for us as well, because you don't have to just constrain yourself to other fixed income asset classes which are in the public markets to achieve that same target. Because if you relax these assumptions and start to focus on these illiquid asset classes, which are better understood now using the extent of our data, there is scope for increasing the allocation and invest a lot more in infrastructure debt than is currently done. So most of this allocation that you see, the high allocation for infra debt, it comes as an offset from government bonds and corporate bonds, which get reduced in terms of their allocation, and that gets ported over to infrastructure debt. So that was the last bit that I wanted to share. And with that, I wanted to leave you with some key facts about infrastructure debt. So what we have seen today is there are some clear benefits of infrastructure debt investing. One is that it offers long repayment periods. We saw that the credit risk profile is quite attractive. Overall, the credit risk is quite low in this asset class. We saw that it offers diversification from bond market, and obviously there's outperformance benefit as well, as we showed in the comparison. So there's a scope for a positive spread pickup against these corporate bond markets. So these are the attractive features behind the comparison between the two different asset classes in the fixed income market. In terms of the risk-adjusted performance, it's quite attractive. We have a Sharpe ratio of greater than 1, and while we observe it on a gross of fees basis in this data, but even after the fee adjustment, it will remain quite attractive in terms of the Sharpe ratio. Finally, through that illustration in the SAA, we find that the liability hedging characteristics are quite strong, that if you can use infrastructure debt in your portfolio, you can actually use it for your ALM or liability hedging purposes by matching duration, or getting a more predictable cash flow profile, and at the same time get some diversification from other fixed income markets. Those were the key things that I wanted to show you. This presentation was intended to give you a sense of how you can benchmark infrastructure debt in different ways and to what extent our data allows you to do that in the Infometrics platform. I hope you found it interesting, and over to you, Brendan, now.
Thanks, Abhishek. Well, first of what I'm going to do, yeah, this is it. This is the slide that I wanted to leave the audience with, because we've had an obvious question: are the slides available? And you can get a lot of material here. Let's pause on this one for a minute. I'll ask you a question, Abhishek, and then we'll go to an actual email address for folk who want to get a copy of the presentation, because it is available on request from EdTech Infra. That's the short answer. Just regarding the modeling and making the most of the EdTech Infra data, Abhishek, do your clients currently go in and are they able to do the kind of modeling that you've demonstrated here? Can they play around with the data to suit their own liability profile, their own risk tolerance? Or do they have to sort of rely on you? How free are they to interpret and model the data as they wish?
Well, they could use the results that we publish. For example, the expected returns or the risk profile. We publish it in our Infometrics platform for different segments of within infrastructure debt. So they could use these inputs directly in their own assumptions for strategic asset allocation whenever they start to build a profile of their whole portfolio, what it should look like, and so on. They could use these inputs directly in that exercise. So that's readily available. In terms of the valuations, definitely that they could get a benchmarking exercise using our data in terms of spreads or yield to maturity and so on. It's all available in the platform, and that allows them to benchmark or value their own investments within any market. So there are ways to use that data readily. And then obviously there are custom arrangements that we have with some clients if they want something more niche or something more tailored to their own requirements.
Okay, that sounds like the beginning of a conversation, because we've got a couple of questions naturally that ask some more about this. So, for example, let's have one. In your index history performance table, do you adjust for the vintage year of the infradebt group, or do we have the split by vintage for your infradebt index?
Right. And I mean, that's a very interesting question. And we had that question on infra equity a couple of years ago. That's why the product that I mentioned, Fund Strategies, we created that product to show that view, the vintage view on unlisted infrastructure equity investments. We have a plan to create a similar product on infrastructure debt. It's just not available at this point, but we understand the requirement for that product because a lot of investors invest via these closed-end funds or private funds in infrastructure debt as well. Yeah. So for them, a vintage view is quite important. Infrastructure equity took the first preference because that's a bigger market, but overall it will be expanded to infrastructure debt as well.
Watch this space. Good question, good answer, thank you. Is the data set gathered from public sources or through partnerships with other investors?
So the data set is gathered from the audited accounts of these infrastructure companies. We have 700 plus companies in our universe. So it's a very lengthy exercise that we have to do every quarter and go and find these audited accounts with the regulators in the respective jurisdictions and so on. So it's a very detailed process, and we take line by line accounts for like financial statements, balance sheets, cash flows, and so on, and store all of that data in a very structured format in our database so that we can build models on top. Okay. Now, increasingly, we are going to look at the contributor data as well to cover the markets where we lack some coverage. For example, I mentioned the US market. So that's a focus for us going forward, that we expand our universe coverage via that route.
Yeah. Thank you. Next question. What's the average internal rating? That's actually regarding the project finance.
Yeah. So, I mean, we haven't computed the ratings yet, we have all the credit risk metrics in our data, and theoretically we could use a rating provider like S&P or Moody's to compute a rating. It's just that we haven't done it yet, because then it becomes a question of confirming that rating on the borrower. But it's something that is in pipeline as well, that we want to take this to the next step, because once you have computed probability of default or expected loss or loss given default, you can easily use these metrics and map them to create a rating for any kind of debt instrument, not just project finance, for example.
Yeah, yeah, yeah. The issue then is, well, I'll come on to that. I'll park that the obvious question in a minute. I just wanted to bring up this slide. It's quite small, folks, but can you see at the top right of your screen, to find out about index data and analytics, contact sales@edtechinfra.com. So that would be the email address to which to request a copy of the presentation. It is available. This webcast remains on the IPE site for the foreseeable future, as do all the other great webcasts that Abhishek and colleagues have done over the years. So you can watch it again, or tell colleagues. But if you want a hard copy of the presentation, sales@edtechinfra.com is the email to which to send your address. I'll have one of my questions, actually, Abhishek. And that, you showed the segments near the start. Just to pick on one that I think would be attractive to IPE viewers, and that's the green infra debt index.
Yeah.
Is it available in an investable format?
Not yet. I mean, it's an index that is built on the private assets. So these are all private instruments. So it's not directly investable at this point. But increasingly, we are seeing interest from the investors in this asset class who want to use our data and create investable products based on them. So they would be either using our index directly, or a tailored index that mirrors their portfolio, but that becomes investable then, because their clients can invest in their portfolio and then it tracks our index. So that becomes a very interesting use case. We are having more and more conversations along these lines.
Yeah. Okay. So it's one in gestation. There's lots of banks, asset managers, everybody in the investment universe watching today. If you're interested, I suppose they'd contact that same email address initially, Abhishek. I know you're in conversations with providers already.
Yeah, let's
for now just say sales@edtechinfra.com if you want to think about a commercial partnership with Edtech Infra. And before we went on air, when we were discussing this point, you said that actually how it may manifest itself. Well, it could be lots of different vehicles, we know, but you suggest it might sort of take the form of a CLO, which is interesting to viewers, because obviously then you get different tranches depending on risk appetite.
Yeah, and then CLOs let you structure them however you want, because once you have got the underlying credit risk figures, you can create as many tranches with whatever seniority you want to see in the market. So it allows you a lot of flexibility. And that's a product that I see has definite use case in this a product that is investable based on this data.
Yeah, especially, yeah. It was the green infra that caught my eye. So many investors trying to be part of the decarbonisation process. We've got some more great questions. Let's stick with that point about internal ratings. It's a good one. If there are no internal ratings attached to loans, how are the probability of default and recovery rates being calculated?
Yeah, so that's an interesting one. So we have a structural credit risk model that is built using the data that we collect. So it includes the financial structure of the companies. On the equity side, we have a lot of data as well. So we use all that data. We have a structural model built for credit risk alone that gives out these estimates of probability of default and other credit risk metrics that you see today. I think I'm going to do a separate webinar on just credit risk in a few months down the line to go in a bit more detail of that model. It will be a bit more technical. So while this webinar showed you everything that we offer in Inframetrics, now we can take each component and show you in a bit more detail later on to what extent can we do and how far we can go with that model.
Yeah, I think that would be great, as we've had a number of questions on it. Look under the bonnet. Thank you for that. Can you talk about the performance of fixed versus floating rate?
Yeah, so I mean, it's a bit of a question that we haven't really looked at yet. But if I think there is a metric on that in the platform that we show split on fixed versus floating within all the segments in infrastructure debt market. And if I remember correctly, we have floating rate spreads which are a bit higher, about 10 to 20 basis points higher than fixed spreads on a long-term basis. So overall, in terms of pricing, that's what we see in the data, based on our own modeling, obviously. But if you want any more details, then I encourage you to look at that platform, because I didn't consider that in this webinar.
There we are. There we are. That's great. These people aren't putting their names. It would be great if we had the name of the organisation and who these folk are, but they know their stuff. That's good, Abhishek. Always nice to catch you out. I didn't manage to, as the journalist. One last question, and again, this is a cracker. It's on, well, relates to everything we've discussed so far. For default risks in years 10 to 30 for project finance debt, where investors are effectively locked in, might the default risks be much greater than the 10-year data show?
I mean, the default risk is obviously the highest during the construction period, because once the construction completes and the viability of the project has been determined, the rest of the cash flows are more predictable. So the default risk comes down a lot. So I would say that in the initial 5 to 6 years, that's when the construction peak is there, the construction risk is there. I think the default risk is the highest at that point. And once the asset becomes operational, that obviously comes down a lot. So it should continue like that after year 10 as well.
Yeah. And to ask a sort of simpleton's question, surely just anything in terms of probability becoming outdated, some things do in a often for strange reasons, for policy reasons above them, the country decides to switch off a particular source of power, for example.
Yes.
So these are exogenous, you could say.
Exactly.
But
and they happen. I mean, we saw these risks getting realized in Spain, for example, with the toll roads and solar plants and so on. So the policies changed, and obviously it realized the risk. But there's something that you can't model upfront. These are exogenous, like you say, and we will see when they happen.
That's the problem with you quant people. You always introduce exogenous risks once they appear. The other risks, the market risks, gets modelled well. Yeah. Exogenous risk, well, basically that's not what we do, is it? How would we know what the Spanish government? Yeah, magic. Okay, we've run out of questions. We've run out of time, and that's a very happy place to be. It's been a great webcast, very entertaining. Thank you very much, Abhishek, once again. Look forward to you coming back. So hopefully that'll be this year, 2022. We'll see you to explain more how you do that credit risk modelling at EdTech Infra. I think the audience got the contact details. It's all fairly obvious. And that paper, folks, is also available on the EdTech Infra website through one of those links. Just remains for me to thank you. I think we're much clearer on how to benchmark infrastructure debt.
Thank you very much, Brendan. That was a very lovely webinar, and I hope our audience got some information that is useful for them.
Yeah, judging by the questions, they certainly did. So it just remains for me to thank once again Abhishek Gupta from EdTech Infra. Thank you, the IP Real Assets audience, for your great questions and participation. This is Brendan Mayton for IP Real Assets, wishing you all a very good day.